Let's start putting together our statement of cash flows now. We understand the three buckets: operating, investing, and financing. To help us understand the investing and financing sections, let's take a look at Target's statement of cash flows. For now, let's ignore the operating section. We'll get to that one later. So the investing and financing sections are set up very similarly. Investing has a lot to do with property, plant, and equipment. And right now, it shows that Target spent $2.8 billion. This is in millions, so that would be 2.8 or $9 billion on property, plant, and equipment. You'll also notice that they have a separate line for sales of property, plant, and equipment. So they bought a bunch of stuff, they sold some stuff, and those have to go on two separate lines. Now, we can't get this information just from the balance sheet, just from the income statement, and so forth, and because the other financial statements often summarize this data into one number. For example, the balance sheet would show we just had a change in property, plant, and equipment. We don't know how much buying and selling went on between the beginning of the year and the end of the year by just looking at those two numbers. So finding these numbers ends up being, in real life, difficult. So we do need to separate it out into two different lines. One for how much did we spend on it, and then another line for how much did we sell. Notice also this is the cash amount. It does not include gains and losses. It's just how much cash did we spend on it, how much cash did we get from it. They also have this other line for other investments that could be some like stocks that they invested in and such. That also goes in the investing section, but you can see that it is pretty small compared to the amount that is in the property, plant, and equipment. All right, let's jump down to the financing section as well. Financing section, we said, involves two things. It's transactions with loans, mainly long-term loans to finance the business, and transactions with owners. Target has both of those. They have additions to long-term debt, meaning this is the cash they got from a bank or other loan. So that's the cash amount. They also paid back some debt. So this is the cash amount that they paid on the loans that they already owed. All right, so those are the banks or the loans. They also had dividends, meaning those are the payments they made to their owners. If a sole proprietorship, we would call that a drawing. So they paid their owners here. They also repurchased some stock. That's something that we're not getting into in this class, but it's something that you will see on these cash flow statements. They also issued some stock option exercises in some years that might be for their employees or something. So we have transactions with owners and transactions with banks and other lending agencies. Notice in this section as well that we have to separate the two. We separate the how much money did we get and how much money did we pay for both of those. So how much money did we get from the banks? How much money did we pay the banks? How much money did we get from our shareholders? And how much money did we pay our shareholders? So we have to separate all of those things. Just to remind you again, getting these numbers in real life can be very difficult. This is what caused me to spend hours and hours trying to figure out where is my statement of cash flows going wrong here. I could spend 4 hours trying to find one mistake because it's buried in the details somewhere in some obscure account, like, oh, that's it, and then I'd finally find it. For this class and homework, it's actually the opposite. So the investing and the financing sections are really easy because you are given the information. You don't have to go digging for it. I do want to point out in real life, it's difficult. let's go through an example of putting together one of these sections, or two of these sections, the investing and the financing. All right, so let's say we borrowed $50,000 from the bank, bought a new warehouse, and paid a $5,000 drawing to our owner, sold old computer equipment, and received $20,000 from the owner. First thing that we're going to do is we're going to classify all of these as either investing or financing. All right, borrowed $50,000 from the bank. That has to do with our financing section. So let's put that in there. Bought a new warehouse for $80,000 cash. That's an investing. Again, who are we investing in? We're investing in ourselves. The drawing is a financing activity. It deals with a transaction with the owner. Sold old computer equipment. That's an investing activity. And received $20,000 from the owner. That's a financing activity. All right, let's also say if these are positive or negative cash flows. If we got $50,000 from the bank, that's positive. Bought a new warehouse, that's a negative. Paid $5,000 to our owner, negative. Sold an old computer, we got $2,000 in cash. And then we received $20,000 from the owner, that's also a positive. Now that we have those classified, let's put together the sections. Each section is going to have a title such as cash flows from investing activities. Excuse my handwriting. And then we need to separate the different investing activities. We cannot usually net them. We can combine all of our equipment purchases and combine separately all of our equipment sales, but we cannot combine the equipment purchases and the equipment sales together. So we can put a title such as purchased warehouse. And we would say negative $80,000. And then we would put sold computer. As we saw on the statement of cash flows from Target, they're a little bit more general. They might just say purchased property, plant, and equipment and sold property, plant, and equipment. Or they used fancy words like expenditure and proceeds. The point is that investors are going to understand what you're saying. All right, so we have our two investing activities here, and that comes out to a negative $78,000 in cash flows from investing activities. So our subtotal is going to have a title such as cash flows, and it's either going to be provided by or used by. It could be provided from. The terminology differs somewhat depending on which company you're looking at, but we need to make our language match what the cash flows actually are. So in this case, we'd say we have a negative, so we would use the terminology used by investing activities, and we would not use provided by. Provided by is if we have positive cash flows. All right, so that's our investing section. Let's look at our financing section. And hopefully I have enough room here. So cash flows from financing activities, or something to that effect. And we would now list all of the things out. We would say proceeds from loan, or cash from loan. Again, the terminology, we just need to make sure that our investors are going to understand what we're saying. This was a positive $50,000. We also paid a drawing, so we could just put drawings or dividends paid or something like that. This was a negative 5,000. And then we received a contribution from the owner, so we can just put owner contributions. And that's a positive 20,000. So our total here is going to be $65,000 positive. So we can say cash flows provided by financing activities. All right, so we have two subtotals here. We have our subtotal for investing activities, subtotal for financing activities. So both of those sections are pretty straightforward, at least in homework, because you're given all that information. Your biggest job is to classify them into the different activities, use the correct language for the subtotals, and such. Let's go back to the target financial statements to see how they finish it up. Now, again, I said that for now, let's ignore the operating section and how that's put together. But notice we do have a subtotal for operating, a subtotal for investing, and a subtotal for financing. The next thing that we do is we add all of those subtotals together. With target, they said our net increase during the year was $957 million. And the next line, finishing up the statement, we have what did we have at the beginning of the year in cash? So we add our change. What was it at the beginning? And that gets us to our ending number right there. All right, so that's how we finish up the statement of cash flows, as we add all those subtotals together, find out what was the change, what was the beginning, add those two things together to find out what was it at the end. If you're trying to check to see if your total is right, is this $4.7 billion in cash the right number, or did I make a mistake along the way? I can double check that by checking the cash balance on the balance sheet. The balance on the statement of cash flows should match what is on the balance sheet. And that's usually where I ran into problems when I was putting these together professionally, that the first three statements, income statement, statement of owner's equity, and balance sheet, were all very easy to do. Usually it was you put the numbers in and the Excel spreadsheet did all the work for you. Statement of cash flows was the hardest one, and usually I ended up with a difference that I had to figure out, all right, what is going on here? And it took me hours sometimes to figure out what was wrong. So that was usually a very good check number. Is my ending cash number on the statement of cash flows the same as what I have on the balance sheet? And they should be the same.